So inventory valuation, the whole picture, right? So I'm doing accounting, so I love accounting, and I don't like people who cram accounting. I want you guys to understand what you're doing. I want you guys to understand the principles. So with inventory valuation, it says from the name, right? So what we're trying to do is we're trying to value our stock inventory or our inventory. So that's it. So we're trying to value, meaning that we're trying to put an amount on our stock. That's basically it with inventory valuation. We're trying to put an amount on our stock, right? So we have two components. So the first thing, we have what we call a recording system, and secondly, we have, so a recording system is something like perpetual versus periodic. So this is an inventory system, right? And it's very important to understand the recording system. Recording system. It's very important to understand the key differences between these two recording systems. With perpetual, what happens is every time we make a sale or at every point of sale, we update the cost of sale account and inventory account. So every time we make a sale, we update the cost of sales account and inventory account because stock is leaving our business. That's under perpetual. Even when we buy goods, we directly update our inventory account. So that's perpetual. Every time we make a sale or we buy goods, these two accounts are affected. When we make a sale, cost of sales is affected as well as inventory. When we buy goods, only inventory is affected because our inventory is increasing. But with periodic, it's a different story now because these accounts are only updated once at the end of the year. So that's the key difference. Perpetual, the inventory and cost of sales account are constantly updated during the year, right? Every time there's a transaction that affects either of the account, we update the cost of sales or inventory account. But with periodic, we don't. We only do it at the end of the financial year, right? So cost of sales account, we only touch it at the end of the financial year. Inventory account, we only touch it at the end of the financial year. When we buy goods under periodic, we debit purchases instead of inventory. We don't debit inventory. When we sell goods, we don't calculate the cost of sales at that point. We just leave the cost of sales section. We just post on the sales account and bank, increase our bank. So that's the key difference. Under periodic, we don't update the inventory and cost of sales account during the year. We only do it at the end. So that's a recording system. And then we have what we call a, forgot what they call it, but an allocation valuation method or allocation system, right? Allocation method. So this is basically saying what value do we put on our closing stock, right? So, okay, cool. We have closing stock at the end of the year, but what value do we put on that closing stock? What value do we put on our closing stock? And that's where we get FIFO. This is weighted average. So FIFO is saying first in, first out, right? The first stock that we bought or that entered the business is the first one that's going to leave the business. So at the end of the year, when we valuing our closing stock, what we do is we take the cost price of the latest goods that we bought, because we're assuming that the things that we bought the latest, those are to the financial year end, are the ones that are still in the business. That's five. We're assuming all the ones that were first, we already sold them. What's left is this one that we bought closer to the end of the financial year. But with weighted average, we calculate some sort of weighted average. So we take the cost of all the goods from opening, all the purchases plus all the purchases, and then we divide by the number of units, and then we get a weighted average. So that's the key difference. This is just saying what value do we put on our closing stock. You'll see it with this question we're doing now. So they're saying you are provided with the information relating to Mzansi Traders owned by Tami Mzansi. the business sells one type of cellular phone, so they sell one type of cellular phone, and the financial year end is the 31st of December. The business uses the FIFO method to value their stock. FIFO method, very important for you to highlight it, because you're saying, okay, now I know they're using which valuation method? The FIFO, meaning that we assume that the way we value our closing stock is taking the cost price or the purchase price of the latest stock that was bought. All the stock that was first, we already sold it. Now we left with the latest goods in our closing stock. And then they say to value the stock, and they use the periodic inventory system. Periodic. Oh, what system are they using? Periodic. Meaning that during the financial year, cost of sales won't be affected, inventory won't be affected. The inventory account and cost of sales account, they won't be affected. They'll only be affected at the end of the year. Remember, under periodic, we only calculate the cost of sales at the end of the year and not at the point of sale. That's the key difference between perpetual and periodic. So your first question, they like calculate the value of closing inventory according to the FIFO method on the 31st of December 2011. Straight to the point. What value do we put on our closing stock, right? What value do we put on our closing stock? We go now, we say, okay, cool. Let's go and see. Let's go and read our additional information. They didn't tell us specifically which additional information we should go read, so we just need to like skim through all of them and see which one is going to be helpful for us. So inventory on cellular phone, the stock were as follows as at the beginning of and the end of the financial year. So the stocks were as follows. The stock were as follows at the beginning. Oh, this English is not making sure, man. At the beginning and the end of the financial year. So what they basically saying is, at the beginning of the year, we had 450 units at per unit cost of 530. The total value was this much, but the closing stock is 280. Remember, I said evaluation method, which is FIFO, we're basically saying what value do we put on this 280 units that is our closing stock. Because you see, they gave you the value of the opening stock. We know the value of the opening stock because we calculated it at the end of the previous financial year. But now we have these 280 units. What value do we put on these 280 units? We go, what valuation method do we use? We use FIFO. So we need to go and value these 280 units using FIFO. Now we go, which stock did we buy the latest or closer to the end of the financial year? Is this stock that we bought here on the 30th, and this stock that we bought here on the 30th of September, right? So the stock that we bought on the 30th of November, that's the latest stock we bought. Remember, with first in, first out, we're assuming all the earlier stock is already out. It's the first stock that we sold. Now, what's sitting in our closing stock is the one that we bought at the later state, meaning that it's this 200 units that we bought on the 30th of November. So if I were to answer question 1.2.1, I'd say, okay, cool. They said here we have 280 units as closing stock. And I know that 200 is made up of the stock that was bought on the 30th of November. So your closing stock will be that 200 units. So it's that 200 units times the purchase price, cost price per unit, which is 620. And don't forget the carriage per unit. So the cost of transport or whatever, we also added to the cost of purchase, right? The purchase price, because it forms part of the cost of getting this inventory or whatever. So we have to add it as part of like we have to add it as part of your cost. So here we've only included the purchase price, meaning that we need to go and say, okay, cool. But there was that carriage that we incurred as well. So for the 200 units, we incurred 30 per unit to transport these goods to our business. So we need to include them as well on the cost, right? So this is the value of your closing stock. But remember, they said we have 280 units on our closing stock. We've only accounted for these 200 units. So meaning that the 80 units comes from the one that was bought on the 30th of September. The 30th of September, the 80 units. So 200 units is from the 30th of November. The 80 is from the 30th of September. So meaning that we need to go and add that 80 times the purchase price of 530. We add the carriage, which was still 30 rand, and then you get the total cost price. So if you add these ones, they're gonna give you 130, 123. So it's 130,000 plus 80 times 580 plus 80 times 80, which is 800. Is this one, and you add it with 130, get 174, 800. Happiness, any questions on that one, on how you calculate the value of closing stock? Any questions? No questions. Are you guys happy with that one? Thumbs up. Okay, I is happy. Okay, cool. If there are no questions, we can continue. 1.2.2, they say calculate the following for the year ended 31st December 2011, the end of the financial year. So they need us to calculate the cost of sales and also to calculate your gross profit. You may prepare a trading account to assist you in these calculations. Okay, cool. I'll just do this. Say your 1.2.2. So let's start by cost of sales. So cost of sales, how do we calculate our cost of sales? It also depends on your valuation method. Are you using FIFO? Sorry, not your valuation method, your recording system. Are you using perpetual or periodic? So here they told us that we're using periodic, meaning that we only calculate cost of sales at the end of the financial year. And how we calculate cost of sales, there's a formula that you take opening. So you take opening. I'll just write it over here. So cost of sales is equal to opening stock plus all the purchases minus your closing stock. So that's your formula for cost of sales under periodic. You take your opening stock, the value of the opening stock, you add all your purchases, and then you minus your closing stock. So what this is basically saying is we had this much opening stock to sell during the financial year. We added by purchasing more of this much that we could sell. Now we only left with this one, meaning that the difference between the two is what we sold. That's why we're saying it's cost of sales. That's the assumption they make there. So now you go and say, okay, cool. What's the value of the opening stock? They gave you the value here as 238,500. That's the value of the closing stock. What's the value of your purchases, right? So here is very important for you to know that when we talk about purchases, we talk about net purchases, meaning that we need to exclude the items that were returned back to the supplier. So if you read this additional information here, they say Mzansi traders were not happy with the price of purchases on the 30th of June. They're talking about the purchases that were made here. Therefore, they returned 100 cellular phones to the supplier. The supplier created them with the cost price of each item, excluding the carriage, right? So of these purchases on the 30th of June, they returned 100, meaning that out of the 900, 100 was returned back to the supplier. and the supplier refunded them the purchase price only. That's very key. They refunded them the purchase price only. So you have now, how do we calculate our net purchases, right? So let's go and calculate. So our net purchases will be, if we can just take this total over here and add this total over here, say, okay, cool. Our total purchases before we account for the returns was 2,259,123 plus include the carriage. Remember, I said whenever you're valuing your inventory, you must include the carriage fee, which the total carriage fee was how much? It was 66,000, right? So this is your total purchases. But remember, we're looking for net purchases after the returns. So we must go and subtract the 100 units that were returned. But remember, they only refunded them with what? Only the cost price of each item, not the carriage fee. So we're not going to go and subtract the carriage fee that was related to that 100 units. We're only going to subtract for the 100 units, multiply that amount by the cost price per unit, which was 600, and that's how you get your net purchases. And in total, after that, you minus your closing stock, which we calculated here as 174,800. So ultimately, we're going to have opening stock of 2. I don't know what's happening now. So ultimately, we're going to have opening stock of 238,500, and then we add the net purchases, which is going to be 1259123 plus 66,123 minus 60,000. Your net purchases is 11265,123. Then we minus the closing stock of 174,800. Therefore, we get 8,500 plus 2,653 minus 174,800. We get 1,328. So you get 1,328,700 as your cost of sales. Everyone happy with that one? Everyone happy with that one? Thumbs up if you're happy. Okay, cool. Chamo is happy as well. Polo is happy. Okay, cool. So we're done with calculating. This is your cost of sales. So see how important it is to not forget the amounts that you calculated above, because you see in this calculation, we had to use this closing stock that was calculated above. So if your answer here was wrong, you're going to get wrong here. But if you come here and use the same wrong figure here, you're going to get a box mark, because you understand the principle that this is the formula you use to calculate the cost of sales amount. If you get here now, put a different figure than the one you calculated above, then we give you wrong because you don't understand what you're doing. But anyway, now they say calculate the gross profit. Remember, it was a two-part question. The second part was gross profit. And we all know that gross profit is what? Now you think of your income statement. That in your income statement, you have your sales. That's cost of sales. And then you get gross profit. So your sales, did they give you the sales amount, the total sales? So they said the sales for cellular cell phones was 2270 units at 900, which made up of, which ultimately was 2043123. And your cost of sales, you see now, it's the same thing we calculated above there, which is 1,328,700. Then you get your gross profit as 714,300. Happy days. Everyone happy with the gross profit? Happy. 1.2.3, they say use the figures calculated above to calculate the markup on cost. So markup on cost, you know how you calculate. This is 1.2.3. So how you calculate the markup percentage on cost? It's from the name, you know that you'll have gross profit on top over cost of sales. That's how you calculate the markup on cost, right? Gross profit on top, and then you have cost of sales. Your gross profit was 714,300. Your cost of sales was 1,328,700, meaning that you get markup on cost of 1,328,700. So I'm getting times 100, you multiply it by 100 obviously to make it a percentage, get 53.76%. So you have to multiply by 100 over here. Get markup on cost of 53.76. So that's the markup on cost. Therefore, the last question, they say refer to the markup percentage calculated above. Comment on whether this markup percentage has been beneficial to Mzansi traders in 2011. Note that in the previous financial year, the gross profit was 400,000 and the markup was 75,000. So what's this markup that was achieved in 2011 beneficial compared to last year's figures or whatever? Was it beneficial? I'd like to hear some thoughts on this one.